Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of January. The US equity market closed 2024 as one of the best years in economic history. The Fed remained consistent in its well-telegraphed path toward lower rates, at the same time leaving the door open to pause sooner than expected if conditions require a more hawkish approach. Undeniably, 2024 was a year that will have its own chapter in future economic books, perhaps exemplifying the first instance of economic deceleration without a landing or recession. Within that context, credit metrics, labor market, and to a certain extent, consumption figures have declined from all-time high levels, but not to the point of concern. Our proprietary recessionary indicator is assigning only an 11.64 recession probability in the US the next 6 months. It is reasonable to expect a more volatile first half of the year, where the market will have to parse, dissect, and adapt to the policies that the new administration is expected to implement. Decisions related to tariffs, massive deportations might have an inflationary impact which could derail the Fed's ability to continue cutting rates. However, regulatory easing, a broadening of AI-related capital spending, and a change in energy policies could further support US exceptionalism. One of the biggest questions for 2025 revolves around the direction of the US fiscal deficit. Ex ante, it is expected to worsen as a result of combinations of actions such as tax cuts and other fiscal benefits, as well as an increment in government spending. These could be partially or completely offset with the drastic optimization and cost savings plans that Elon Musk is proposing to deliver, although it remains unclear how and when these are going to be implemented. The allocation to high yield, on the other hand, was changed from underweight to neutral. Credit risk metrics provide good support for the asset class, which, combined with private credit providing ample liquidity on the sidelines, could act as a shock absorber in case of unexpected widening of the current spread levels. On the US equities front, we have introduced an active large-cap blend manager to the mix. The manager has a dual allocation to growth and value companies, with a 20-year track record not only outperforming the S&P 500 index, but also displaying a persistent lower historical level of volatility than the index. The rotation of assets into this manager comes from reducing the allocation to passive and value-only managers, as well as reducing the exposure to real estate in the portfolio to neutral. The allocation to long-short active management in Europe was augmented to account for the subpar growth outlook for the region, divergence across European economies, and the risk of new tariffs on export in European exports, which requires the need for a strategy that could profit in a broad range of market scenarios. The allocation to Japanese equities was adjusted to match the benchmark allocation. Finally, we remain underweight in Asia and emerging markets, while maintaining an overweight to US equities, where we expect the former to continue to outperform in relation to the latter. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.